First look at second quarter GDP, minus 32.9.
Its worst GDP drop on record, that is in history.
We mentioned the historic plunge in GDP for Q2.
When you have a growing economy, which happens about 95, really more like a 9% drop because we annualize it.
Our gross domestic product, it was below zero. Who ever heard of this?
Now it is in recession, a staggering contraction of 32.9% from pandemic wiped out the last 5 years of economic growth in just a matter of weeks.
Hi there, and welcome to the first lecture on a series of lectures on economic indicator. My name is Jason Dean, and I'll be your instructor for this course. In this video, I'm going to cover the most closely watched economic indicator, and that's gross domestic product, or GDP. As a CPA or other business professional, I'm certain you have some understanding of what gross domestic product is. The purpose of this lecture is to provide you a practical review of GDP and cover some of the nuances you may not have learned in your studies. So what is gross domestic product? Well, in a nutshell, it's the market value of all final goods and services produced within a country in a particular period of time. This indicator is reported monthly, quarterly, or annually. Now, as the word domestic in the title suggests, it refers to the production that is done within a country's borders. So it includes any domestic production regardless of who owns the resource. So if we're thinking of Canada or the US, we're talking about all of the production that is done within the border, and that's regardless of who owns the resource. For example, if a non-resident of the US owns a factory in the US, that production, because it's within the US, is included in gross domestic product. However, production done by a US citizen outside of the US is not included in GDP. Also, GDP includes all private and public consumption, including for-profit, non-profit, and government sectors. A useful way to think about gross domestic product is to think of a spreadsheet, for example, with 4 different columns. In the first column, you would have listed all of the final goods and services that were sold in the economy. The second column would have their price, and the third column would have their quantities, and the fourth column would be the price times the quantity. And so gross domestic product would be equal to the sum of all of those prices and quantities. So you can think there was going to be, thousands of goods and services, and in the end, GDP would be obtained by taking the sum of all of the prices times their quantities. And so in this example, we could get something like $1.35 trillion. Now, if we're using the current year's prices times the current year quantities, we call that nominal GDP. We'll talk more about that later in the lecture. So why do we care about gross domestic product? Well, it's the most comprehensive and closely watched economic indicator, and it's watched by many different individuals, many different professionals such as traders, government officials, business executives. And why is it so interesting? Well, it's used to track the overall economic health of a nation's economy. It answers the question of how much economic activity occurred in a country, and it provides information about the size of the economy and how it is performing. And as we'll learn later, it's a key variable used to measure economic growth. Since it measures economic activity, changes in GDP over time measure how much the economy is growing or contracting. It is also very important for business managers who perform strategy and planning and also forecasting. GDP, in fact, is a key variable in forecasting models. For example, it can be used to forecast revenues and costs, and also it's important when making decisions about jobs, expansions, and investments. So this is a very important data point for any business executive making decisions and doing forecasting. It's also very important in a similar manner for governments. It's used widely to plan for spending and tax policy and when setting monetary policy. And also for you as a business professional, it's very important to have a good understanding of gross domestic product because it boosts your toolbox of knowledge and skills and further improves your business acumen. In our lecture, we're going to first talk about how gross domestic product is measured. Then we're going to talk about the difference between real and nominal GDP. Then we'll talk about how real GDP is used to estimate economic growth. And then we'll talk about how GDP is related to living standards. And we'll talk about some of the limitations of gross domestic product. and we'll finish up with some active learning questions to help reinforce some of the material we learned in this lecture. So how do we measure gross domestic product? As a CPA, you'll be happy to know that we're going to use a simple accounting framework to measure economic activity. This consists of a set of rules and definitions for measuring aggregate economic activity in the economy. Essentially, it's a government bookkeeping system that measures a country's economic activity, and it offers insights on how an economy is performing. To measure gross domestic product, we're going to use a fundamental accounting identity of national accounts. This identity states that total product, this is the total dollar value of production within a country, is equal to total income and also equal to total expenditure. Why are all three equivalent? Well, first recognize that the market value of goods and services produced must be equal to the amount that buyers must spend to purchase them. After all, the market value of a good or service and the spending on that particular good or service are going to be the same thing. Suppose the final value of a car that's sold is $32,000. Well, of course, that's the value of the final good, and it's also equal to what the buyers will spend to purchase it. Thus, total production, the value of total production equals the value of total expenditures. You might have realized that there's a bit of an issue here because not all of what is produced could be sold. So what about unsold goods? Well, we treat these as if the firm purchased it from itself. So we're thinking about a firm's inventory, and a firm's inventory accumulation is considered an expenditure. And so because of this, they will be equal. So total production and total expenditures after making this adjustment will remain equal. Second, we need to recognize that total expenditures are equal to what the firms receive. So the amount firms receive equals the total income generated by production. For example, wages paid to workers, interest paid to capital owners, rent paid to landowners, taxes paid to the government, and whatever's left over is profit, which is income to the firm owners. Think of an automobile with the final value of $32,000. The composition of that $32,000 includes wages paid to the workers who produced it, interest paid to capital owners, etc. And then whatever is left over is profit to the owner of the firm. So that final value all represents income to households. Thus, total expenditures in an economy will equal total income. Total production is equal to total expenditure. Total expenditures is equal to total income. So it follows from that total production equals total income equals total expenditure. So this is referred to as the fundamental identity of national income accounting. So national income accounting is to economists what assets equals liabilities plus equity is to accountants. So we can do an illustration now to really drive home this identity. So let's consider a small island economy with three people. We have Emma, we have Anna, and Chris. Emma collects coconuts, Anna collects firewood, and Chris makes shoes. Now suppose that a single $20 bill, this is the only money that survived after being stranded on the island, is their accepted medium of exchange. So that's what they have agreed upon to use as money. Now let's suppose Emma currently is in possession of the $20 bill. Now consider the following transaction. Emma buys one bundle of firewood from Anna for $20. Anna buys a pair of shoes from Chris for $20. And then lastly, Chris buys 5 coconuts from Emma for $20. So clearly then, this simple economy demonstrates that the total value of production is $60. We had $20 for each product. Also, what are the total expenditures? Well, they're also $60. We had $20 for each purchase. And what is total income? Well, it's also $60 because each of them received $20 for what they produced. As such, again, we have that total product equals total income and total expenditure. Now, there are 3 approaches to measuring gross domestic product. The first is the product approach. This measures the amount of output produced, excluding intermediate stages of production. And this is related to the slide I did at the beginning of the lecture, where you have all of the goods and services produced, their price, their quantity, and then you multiply the prices and quantities and take the sum. And it's important to point out that we are only considering the final dollar value of goods and services. We're not including intermediate goods, because if we do that, we would be double counting. If we include the cost of the steering wheel in the car plus the final value of the car in our GDP, we would be overstating the amount of production, because the final value of the car includes the cost of that steering wheel. The second approach is called the income approach, and that measures the incomes received by the producers of output. And as we just mentioned in the previous few slides, the income approach will equal the expenditure approach. That measures the amount of spending by the ultimate purchasers of output. And importantly, statistical agencies will use these last two approaches to estimate gross domestic product for their country. So the product approach calculates GDP by simply summing the market value of all final goods and services produced in a given time period. This could be quarterly, annually, monthly. As I mentioned before, we only include final goods and services because including the value of intermediate goods would obviously involve double counting. And of course, then it would state or overstate the level of economic activity. Now, suppose there are N goods and services and their respective quantities and prices are represented by Q1 to Qn and P1 to Pn. Well then, gross domestic product is simply calculated as the sum product of each of these price and quantity pairs. This is exactly what I showed you in the earlier slide. Okay, so in this approach, you would need to have a list of every single product and service in the economy, its price, and its quantity, and then you would do this calculation to get GDP. Let's consider a hypothetical example. So below, we have data on different goods that are produced, and we're considering here in this hypothetical example just an economy of students. And let's suppose that the students consume 4 different goods: coffee, bottled water, photocopies, and pizza. So these are the only goods produced in the economy. We have listed the quantity, and we have listed the price. Now, in order to get gross domestic product then, we simply multiply each of these quantities by their respective prices, and then we take the sum. If we do that, then we would find that the GDP for student land in 2018, that's what this data is for. So this quantity data is for 2018, and this price data is for 2018. And so we would find that the GDP would be $761.25. As you can imagine, this would be extremely difficult for a statistical agency to be able to calculate, because they would need to get the millions of goods and services in a list of them and be able to get each of their prices and quantities. So what's useful about the national income accounting that we learned earlier is that we can also get an estimate of GDP by using either the income or expenditure approach. So let's first look at the income approach. So in this approach, we're going to calculate GDP by adding all of the incomes received by producers. We're going to also include profits and any taxes paid to the government. Specifically, the income approach will include 4 classes of income. We're going to have the gross wages and salaries of employees. And so we're thinking of the gross here. So that's going to include any money that the government's going to get, because we're not deducting taxes. Similarly, for corporations, we're going to add that, and that's going to also be before any, it's going to be gross before any taxes are taken off, or before any income taxes are taken off. And then another category would be any interest and investment income earned by households or companies. And then, of course, we're not just considered corporations, we also want to know what the income is for sole proprietors. So we would add up all of these categories to get a measure of GDP. Now, there's some specifics we need to be aware of. So we also need to consider indirect taxes. Indirect taxes are sales taxes, essentially, like HST, GST. These aren't taken off your paycheck, right? So the gross salaries and that sort of thing don't include this. So we must also incorporate this, because this is money that the government is going to receive. So again, indirect taxes are simply those that are charged on products and not on households or businesses. So their monetary value is not included in the income. But, this value is included in the expenditure approach, which we'll look at next. And so in order to balance the results from these two approaches, we need to add these taxes back. Also, depreciation. So as you know, as an accountant, that when you calculate a company's profit, you deduct depreciation. But we want to be able to balance this with the expenditure approach. And although something depreciated, we're interested in the economic activity in the economy. And so we're in the expenditure approach, as we'll see, we're interested in what gross investment was, not net investment. So net investment would subtract depreciation. So again, when you calculate profits, you subtract depreciation, but we don't want to do that. We want to add it back. So this needs to be added back. And another thing to point out when we talk about indirect taxes, we want to have indirect taxes net of subsidies. So the government not only collects taxes, but it also provides subsidies to some firms. So we want what the net amount is. And so with the income approach, GDP will be equal to wages and salaries plus corporate profit plus interest income or investment income plus proprietor's income. And then we're going to add back depreciation and indirect taxes, but subtract from indirect taxes any subsidies. Now the expenditure approach is the sum of purchases in the product markets. And so it's based on adding each production stage to avoid double counting. Of course, it excludes any financial exchanges or secondhand purchases. And this is because we're interested in the economic activity. That's what GDP is measuring. When you, for example, buy a stock, nothing is being produced there. It's just a change in ownership. So we're not interested in any financial capital or anything like that. Also, secondhand purchases, these aren't contributing to economic activity or production. Of course, any sort of services related to these, like the service that a stockbroker provides, that would be included in GDP, but not the value of the stocks that were exchanged. So there are 4 components of the expenditure approach. The first is personal consumption. That consists of all household purchases of services and non-durable and durable goods. Gross investment. We were interested in the gross investment because we're interested in economic activity. So how much economic activity was performed to create new investment, like a new plant or purchasing of tractors, tools, anything that you would think a business would invest in. And then third, government purchases. And we will exclude any transfer payments here because these aren't, again, contributing to any economic activity. They're just transfer payments. The government collects taxes from households, but then gives a little bit of it back in the form of transfer payments, such as pension payments or EI payments. We're just interested in government purchases. Any activity where the government is purchasing something and that leads to economic activities. The next component is net exports. This is the last component, and here we're going to take exports and then subtract from exports import. So if this is positive, that means that we have sold more to the rest of the world than we bought from the rest of the world. And if it's negative, it would be the other way around. The following equation shows that GDP is just simply the sum of these 4 components. So again, C is consumption, I is gross investment, G is government spending, X stands for exports, M stands for imports, and when we take exports and subtract off imports, we have net exports. Now, it's important to point out that either of these 2 methods, although from our national income accounting identity, we know that they should be the same, these need to be estimated. And so you're not going to get perfect estimates when you do that, although they're fairly good. So in principle, they should be the same, but the economy is extremely complex and measurements are never going to be exactly perfect. A typical statistical agency will do when they collect data and publish or report the figures on GDP, they will add in this category called the statistical discrepancy. And it's simply just the difference between the 2 estimates. And what they do is divide that difference in half and then add it to the estimate that's lower and then subtract it from the estimate that's higher so that both will balance out. So again, half of the amount of the difference will be added to the lower estimate and the other half deducted from the higher estimate. And as a result, then you will end up with the expenditure approach equaling the income approach. So let's look at an illustrative example. Here we have data related to the income approach. So we have wages, corporate income, proprietor's income and rents, etc. For the expenditure approach, we have our 4 categories: consumption, investment, government purchases, and net exports. So now, if we were to calculate the GDP based on the income approach, we would use these figures here. Okay, so we're going to add all of these together, and we would get 1879.3. Now, for the expenditure approach, we're going to add our C plus I plus G plus net exports, and we would get 1879.6. So they're very close, but there is a bit of a difference. And so the statistical discrepancy then is just the difference between these two figures divided by 2, and that's equal to 0.2. And so we take 0.2 and add it to the lower estimate, but then subtract it from the higher estimate. And then what we get is gross domestic product being the same for either approach. So in this case, the gross domestic product is 1879.5, and that's in billions of dollars. Now let's look at a really simplified example just to drive the point home. Suppose you were to hire a company to mow your lawn 2 times for $100 plus tax. In terms of the expenditure approach, that would just be $100 plus $13 HST, and it would equal $113. If this was the only activity in an economy, then in terms of the expenditure approach, we would have $113. Now, in terms of the income approach, the net sales for the lawn mowing company would be $100, and they suppose spent $70 in wages, and let's say $5 was written off for depreciation of the lawnmower equipment. Well, then the income for the lawn mowing company would be $25, and that would be their pre-tax corporate profit. Thus, in terms of the income approach, we would add the profit, which is $25, plus the wages, and then we would want to add back depreciation and indirect taxes, which is $13. That's the HST. So when we do that, we get $113. And as you can see, in this case, the income approach would equal the expenditure approach. So up till now, the GDP figure that we've been calculating is not suitable to measure economic activity over time. Why is that? Well, let's look at an example. Suppose that GDP was $125 billion last year and $1.35 billion this year. Now, can we say that economic activity increased by $0.1 billion between this period? Well, if you remember at the beginning of the lecture when we looked at, where we had the columns for the price and quantity, and then we took the sum of the price times the quantity, you could think of having 2 sets of columns, 1 set for each year. And of course, if we compare the calculated GDP value between those 2 years, both prices and quantities changed over that period of time. So to measure economic activity, we're only interested in how the quantities changed over time. We don't want that to be confused with also price changes. Real GDP is a measure of GDP that holds prices constant. And so what the real GDP calculation does is that it will hold constant prices in a particular year, and then GDP will be calculated based on those prices. And so as a result, the real GDP figure over time only shows or reflects changes in the quantity, which is what we want as a measure of economic activity or production. So nominal GDP is the market value of the final production of goods and services within a country in a given period using that year's prices, which we can also call current prices. And that's what we've done up to this point. Now, real GDP is nominal GDP, but adjusted for changes in prices. And it's calculated using bases from a selected base year instead of the current prices used in nominal GDP. Thus, as a result, real GDP holds prices constant over time so that changes in its value will reflect changes in economic activity. So if you think of a series of GDP figures, so if you think about a series of real GDP figures, the differences in those figures will reflect only quantity changes, not changes in price. And so it will accurately reflect changes in economic activity. Let's look now at an illustrative example so you can better understand this concept. Recall our previous example for student land. This is shown here in the first panel, and this is for the year 2018. Now suppose we had an additional 2 years, 2019 and 2020. These are shown in the bottom two panels. Nominal GDP is of course calculated in each of these years by multiplying the current price by the current quantity. In 2018, nominal GDP is $761.25. Now, in 2019, to get nominal GDP, we do the same thing. We take the quantities, multiply them by the prices, take the sum, and we get $883.50. Similarly, for 2020, we multiply the prices and quantities, and we get 1,201.25. Now, to calculate real GDP, we need to pick a base year. Here, we're going to keep things simple and pick the base year to be 2018, which is the year in which our data begins. In order to calculate real GDP, we need to multiply the base year prices by the current quantities in each year. In 2019, to get real GDP, we're going to take these quantities here, 130, 210, etc., and multiply them by the respective prices in the base year, okay? And when we do that, we will get a value of 818.0. For 2020, we're going to take the quantities in 2020 and multiply them by their respective prices, again, in the base year. So we're using all the time the prices in the base year. When we do that, we get the real GDP figure to be 1008.75. Clearly, if we had used the nominal GDP, these figures here, to measure economic growth, we would be incorrectly overstating the amount of growth. That's because overall prices have increased in each of these years. The nominal GDP figures would be capturing both the quantity change and the price change. But since we've held constant prices in the base year, when we calculated real GDP, the real GDP figures will correctly capture changes in economic activity over time. The difference between real and nominal GDP is much easier seen in a diagram. So here's a diagram of the data that we just calculated. So in 2018, nominal and real GDP are the same value. Note that whatever year we choose for the base year, we're going to have that nominal and real GDP are going to be the same, because in the base year, we're going to be using those prices to calculate real GDP in the other years. So since the prices and the quantities in the base year are the ones we're going to use for real and nominal GDP, they're going to be the same. Now we can see in 2019, real GDP was 818, but nominal GDP is 883.50. And of course, in 2020, we see that the real GDP is 1,008 and nominal GDP is 1,201. The difference between these two lines reflects changes in prices, which is what we don't want when we look at economic activity over time. Clearly here, if we use nominal GDP to make any statements about how economic activity has changed over time, we would be overstating it by the difference between these two lines. Now let's look at some real world data. In this figure, we have real and nominal GDP for Canada from 1870 to 2016. We can see here that the point where nominal and real GDP are the same is in 2002, and that's the prices in which the real GDP figure is on. So that was the base year when calculating real GDP. Now, generally prices increase from year to year. There are some exceptions. For example, during a serious recession, we might see that prices actually fall, but for the most part, prices increase. So we can see here that after the base year, of course, we would expect that nominal GDP to be greater than real GDP, and that's what we see here. But for years prior to the base year, it will be the other way around. Real GDP will be greater than nominal GDP. What is interesting about this diagram is it shows how much economic activity has increased over the last century. However, we can't say that much about living standards because we don't have population accounted for here. All we know is that economic activity increased, so the economic pie that everyone could potentially share in the economy increased substantially, but we don't know how much people it needs to be shared among. We will look at another measure shortly called real GDP per capita, which will give us a better feel for the increase in the standard of living over this period. We can see in this diagram that for the most part, GDP is fairly smooth. But if we were to look at the percentage change in real GDP year over year, we see a much more volatile picture. Here is Canada's real GDP annual growth rate between 1962 and 2020. We can see that there are sharp jumps year over year, but for the most part, they are positive. So here is the line for 0, and we can see for the most part, the annual change in real GDP is positive. So what does that mean? That means that economic activity, for the most part, is increasing over time. Where you see that it goes below 0, these are definite signs of recessions. So here we have the financial crisis in 2008, and these were other two major recessions in the early 80s and the 1990s. If we look at the United States, we see a generally similar pattern. We can see where the major recessions are, specifically the 2008 financial crisis. And again, you see a lot of jumping around, but the annual percentage change in real GDP is, for the most part, is positive. And this suggests that the economy is growing over time. Now, it's important to point out what causes the economy to grow over time. In other words, what causes real GDP or economic activity to grow over time? Well, there are two reasons. One is productivity growth. Every year there are small increases in productivity, which increases our output per person. Also, the population is growing and the labor force is growing. So there's more things being produced because there's more people. In developed countries, we usually see growth, especially in recent decades, between 0 and 4%. We usually don't see it exceeding that. Basically, you can think of developed countries have sort of plateaued in terms of their opportunities for productivity enhancements. But that's the opposite is true for developing countries, where they perhaps still have a lot of room to go in terms of being able to implement technologies and increase their productivity. So this leads us into our next topic called economic growth. Economic growth is about an economy's ability or capacity to produce. To measure where it's growing, we need to know if more is produced year over year. Are more goods and services produced this year than last year? So we have already done this, and we've already talked about how nominal GDP would not be a good measure, and we use real GDP to measure economic growth. And we use real GDP because we get rid of the effect of prices, as we already mentioned. There are two key measures of growth: real GDP, as we just discussed, and also real GDP per capita. Let's now talk about how to calculate each of these measures. So how do we calculate growth? Well, we simply use the percentage change formula. We look at the current value, subtract the previous value, divide that by the previous value, and then multiply it by 100. Essentially what we're doing is looking at the difference in real GDP and then dividing by what it was previously. In other words, we're looking at the change as a proportion of what it was before the change occurred. And then we multiply that by 100 just to have it in percent terms. For example, suppose real GDP in year 1 is 1.26 billion, and next year it is 1.29 billion. So we use our formula. We take 1.29, subtract 1.26, divide that by 1.26, we multiply that by 100, and we get that the growth rate is 2.38%. So it's a fairly straightforward application of the percentage change formula. So if we want to look at growth in real GDP, we use this formula. Let's again look at some real world data. So this is for the United States. This shows the percent change in real GDP from the preceding quarter. We can see we have estimates for each quarter from 2016 up into 2020 quarter 2. You can actually clearly see here the effects of the recent COVID outbreak. You can see that the 2020 quarter 2 result was negative 30%. Now this number is the largest number in recorded history. There has never been a time where we've had negative percent change in real GDP this large. There's something also to point out here. One is that when they report this number, although this is a quarterly number, this is annualized. So all they do is just adjust the number so that it's assumed that it would be what would happen for over the entire year. Another thing to point out is that when they produce these figures, they are seasonally adjusted. So they take out the effects of, for example, during Christmas time, there's an increase in economic activity. So they sort of remove that so it's not dependent on these seasonality factors. Now, what does GDP say about living standards? Well, we can pose a question. What is the average quantity of goods and services that people in a country can afford to consume? So it's common to use GDP per capita as a measure of economic welfare or standard of living, or the standard of living of a nation. Real GDP per capita is simply real GDP divided by the population in the economy. So it's taking into account the average gross domestic product per person. Or you could think of our gross domestic product as our economic pie. That's the value of stuff, goods and services that we've created. And we want to know on average how much of that would apply to each person. Now, of course, the real GDP or the economic pie is not equally distributed among all of its citizens. So we can only go so far with its interpretation of living standards. However, looking at changes over time does say a lot. So the formula for calculating real GDP per capita is simply just real GDP divided by the population. Okay? The growth in real GDP per capita will also be calculated using our percentage change formula. And so this measure is very useful for comparing not only the living standards over time within a country, but you can also compare the living standards across countries. Again, here's some real-world data. This shows the long-term real growth in U.S. GDP per capita from 1871 to 2009. What's interesting here now, as opposed to the historical figure I showed you before, is now we can say something about the economic standard of living, how that's changed in the previous 100 years. Because this is real GDP, we have accounted for the effects of prices. So we've held them constant, and we can see then clearly, or we can compare these amounts over time. And you can clearly see that since 1871, real GDP per capita in the US experienced almost a 10-fold increase. What they have in this diagram is a trend line, and then we can see around the trend line we do have some volatility in real GDP. Here we can see the 1929 stock market crash. So this is the Great Depression here. And so clearly here we witnessed a substantial decline in real GDP per capita. Now, we had a much larger decline just recently because of the COVID-19 outbreak. But one of the major differences is that the decline in real GDP during the Great Depression was very prolonged and over a period of almost 10 years. At this point, I don't think anyone's expecting, although we had a very significant drop, much larger than the drop seen in the Great Depression all at once, but hopefully it's only going to be very temporary. But here you can see, if you thought about the cumulative decline, or the total amount of lost economic activity in the Great Depression, is going to be much worse because it was prolonged over a period of 10 years. And here you can also see where some of the major recessions occurred in previous decades in the US. So we have the early 80s, the 1987 stock market crash, the internet stock bubble, and then we have the financial crisis here in 2009. In Canada, we see an overall similar pattern in the last 100 years. Clearly here, just looking at the figures, our standard of living has increased substantially since the 1870s. And this is true for many countries in the world. Here I've just additionally added Great Britain here. So England, Great Britain, and the UK. Clearly the standard of living, as measured by growth in real GDP, has increased substantially in Great Britain as well. However, the standard of living has increased slightly more dramatically in the United States compared to Canada and Great Britain. Clearly, our standard of living has increased dramatically over the last 150 years or so. And a lot of this is due to, the main reason is due to productivity growth. We can produce a lot more per person because of technology and capital than we could back in our past. If you were to think about productivity and real GDP per capita, they're very, very highly correlated. In fact, if we look at measures of labor productivity and real wages, we see that they are very highly correlated. Here we have data in the United States from 1961 to 2007. We have measures here of productivity, and then we also have measures of the real wage. We won't get bogged down with the details, but this dotted line here is measuring productivity, and these two lines here are different measures of the real wage. It's basically, what we can actually afford. So a real wage, similar to when we calculated real GDP, the real wage is, if we look at a series of real wage figures, these are adjusted for prices, so we can compare them over time. Also, the level of the real wage is basically a measure of how much we can actually buy, or our purchasing power. And clearly here in the diagram, you see that the relationship between labor productivity and real wage growth is very highly correlated. So that's a positive relationship. Clearly there is a very high correlation between labor productivity and measures of the real wage. Here is data for Canada, and we also see a very similar pattern, although there are some differences. But the overall pattern of a high correlation between measures of productivity and real wages remains. This data here is from 1961 to 2007. One thing to point out is that in the 60s and 70s, labor productivity was very high. And so we see that there's much steeper increases in measures of the real wage, and that seemed to have tapered off in the 80s and 90s. And we still haven't seen it increase to the degree it did in these early decades, but there has been a slight increase in recent decades. Now, looking at real GDP over time, or comparing real GDP per capita across countries, does tell us a lot about the general economic conditions. However, there are significant limitations of using gross domestic product to make statements about the living standards and, in some cases, growth over time. So gross domestic product does not include non-market activities, such as the underground economy. So any economic activity that's unofficial will not be included in any of the gross domestic product figures published by statistical agencies. It also doesn't capture improvements in product qualities. For example, from this is sort of anecdotal evidence, but I remember that when I was younger, automobiles were not as reliable as they were now. You could purchase a car, and within maybe 3 or 4 years, you would actually have rust on the car. We don't have that now. We very rarely see, even in our climate in Canada, cars getting rusted out unless they're very, very old. So there's a lot of different changes in the product quality that's very difficult to measure, and our gross domestic product figures don't really capture that, any changes in quality. As well, they don't really indicate anything about the composition of output. If, for example, real GDP was lower in a particular year or higher, it doesn't say which goods were the result of that lower. There is some statistical measures where we can look at different industries, but the composition of output, any changes in that isn't very clear in the main GDP figure. Suppose you had two different countries, and one country dedicated maybe half of its GDP to military use, and the other country dedicated half to healthcare. Well, that's quite different in terms of the living standards, how the living standards would be in either of these two countries. The GDPs might be the same in these two countries, but of course, given how that the scarce resources in the country are dedicated to much different things, the standard of living could also differ considerably. As well, gross domestic product doesn't say anything about the amount of leisure. Leisure is not bought or sold in a market, so it's not going to have any value associated with it, and so it's not included in the official GDP statistics. Now, if you were to remember when we looked at the diagram that showed the significant increase in real GDP over the last 100 years, what's not in there is the average hours worked 100 years ago was much more than it is now. So actually, if we're thinking of looking at that real GDP growth over, or real GDP in levels over 100 years, it's understating the increase in the standard of living, because we have much higher output, but we actually work much less to get that at the same time per person. So nothing about leisure is indicated in the official GDP figures. Also, it doesn't say anything about negative externalities. It doesn't say anything about pollution. Pollution has costs. It's not something we want to have in our environment, but the costs of this aren't subtracted, for example, from GDP. So we could have very high growth. We can score very well in terms of our economic wealth, but we might have serious problems with our environment, and these could cause health problems. These are not going to be included in gross domestic product. And also, the gross domestic product says nothing about the distribution of income. We do have our measure of GDP per capita, which is real GDP divided by the population, but that doesn't say anything about how it's distributed. It could be that 5% of the population has 80% of the wealth that is represented by gross domestic product. So if we were comparing real GDP across different countries, two countries could have the same real GDP per capita, but the distribution could be much different. Real GDP per capita is just an average measure. Now, there are measures that help to mitigate some of these issues. For example, the Human Development Index is a measure of the standard of living that tries to overcome some of the issues with gross domestic product. That's out of the scope for this lecture. Here we're just focusing on the economic well-being, but you could look up the Human Development Index, and that will give you a much better picture of the standard of livings across countries, or how it has changed within a country. There is another measure of national product called gross national income. Formerly, this was known as gross national product. This is an alternative measure that tracks a nation's overall wealth. The main difference here is that gross national income is concerned with the income earned by nationals of a country, regardless of where they're living. Recall that gross domestic product measures production within the borders of a country, regardless of whether that production was done by a national or a foreigner. Thus, gross national income measures total income acquired by citizens both within and outside the country. And it's simply calculated as gross domestic product, GDP, minus net income to the rest of the world. Gross domestic product and gross national product are typically very similar, except for countries with a substantial foreign presence in terms of foreign direct investment or foreign aid. Let's look at an example. To keep things simple, let's just assume there are only two countries, Canada and the United States. Now, suppose Canada's gross domestic product is $1.2 trillion. However, $65 billion of gross domestic product was production done by U.S. residents living in Canada. So, domestic income earned by foreigners is $65 billion. Also, suppose that Canadian nationals in the U.S. produced $45 billion in that country. So this would be income of domestic residents abroad. So that's $45 billion. And then when we subtract these two, we get net international income with the rest of the world. So in this case, it's going to be negative 20. We're going to subtract 20 from gross domestic product to arrive at gross national income, which is $1.214 trillion. In this case, gross national income is less than GDP. This is easy to see. We have that foreign nationals in Canada, in other words, U.S. residents in Canada, earned income of $65 billion in Canada, and that was part of gross domestic product. So we're going to be taking that away when we calculate gross national income. But gross national income we need to include any Canadians who had income abroad. And so we're going to be adding back 45 billion. Since what we're taking away is larger, the 65 billion, than what we're adding back, the gross national income will be less than gross domestic product. Now let's talk about how and when gross domestic product data is released to the public. It's important to point out that data related to all economic indicators has the potential to move markets. In order to prevent anyone from obtaining the data earlier than the public, which would obviously provide an unfair advantage, data is released on fixed dates and times, and most importantly, economic reporters must await the release in secure lockup rooms where all communication devices are disabled. In the lockup room, reporters will prepare their stories in advance. Only after the precise time when the data is officially released to the public can they transmit their story. Now, in the US, the Bureau of Economic Analysis is responsible for estimating annual and quarterly GDP estimates, but they also release GDP statistics every month. Why? Well, for each quarter there are 3 estimates. The advanced estimate, which is an early look, and it's just based on the best available data. And then they follow up with a second and third estimate that uses more recently available data to improve the accuracy of the overall estimate. The GDP figures released are seasonally adjusted, and this is to remove the effects of yearly patterns, such as Christmas holidays or factory production schedules. Also, the figure that is reported in Canada and the US is annualized. This just means that the quarterly rate is converted to an annual figure. So the reported rate of negative 30.9% that we saw in the news clips at the beginning of the lecture does not mean that economic activity actually fell by that amount in the second quarter. Simply dividing the figure by 4 tells us that economic activity roughly fell by about 9% quarter 2. The annualized rate just puts the figure into a yearly context. And not all countries do this. Other countries and international statistical agencies such as the Organization for Economic Cooperation and Development report just the quarterly percentage change and skip the. When is GDP data released in the United States? Well, the advanced estimate is released 1 month after the quarter ends. It can be quite different from the third estimate, obviously. All of the trade and business inventory data is not yet in. So the advanced estimate does not include all the available data at that time. That's why they follow up with 2 other estimates that serve to improve its accuracy. So the second estimate comes out 2 months after the quarter. It is of course more realistic because more recent data is incorporated in that estimate. And the third estimate is released 3 months after the quarter. And usually this involves minor adjustments to the second estimate. The Bureau of Economic Analysis also makes in-depth revisions annually. Here's a recent schedule of the release dates. So here we see that the most recent gross domestic product release was on September 30th. This was the third estimate for the second quarter. Also on that same day, gross domestic product by industry and the second quarter 2020 annual update was released. So every month there is new data that is used to continuously improve the quarterly GDP estimate. And we can see down here at the end that the third quarter advanced estimate will be released October 29th. Similar to the US, in Canada, GDP data is released in secure lockup rooms to prevent anyone from accessing the data before the general public and gaining an unfair advantage. The government agency in Canada responsible for compiling and disseminating GDP data is Statistics Canada, and they release GDP data on a quarterly and monthly basis. Every quarter, they release gross domestic product, and they separately report figures for the income and expenditure approach, but every month they release gross domestic product by industry. The latter data is an alternative dimension that supplements the income and expenditure-based GDP estimates. So the annual GDP data are published together with the GDP reading for the fourth quarter. Both quarterly and monthly prints are released by Statistics Canada within 60 days of the reference period. So, for example, the reading for the fourth quarter and the corresponding full year are published by late February or early March. Here is an example of the recent schedule. The release date for GDP, the headline income and expenditure figure, are listed here. So on February 28th, 2020, the fourth quarter 2009 estimate was released. And then on May 29th, 2020, the first quarter GDP for 2020 was released. Moving forward, on December 1st, 2020, the third quarter GDP for 2020 will be released, and so on. Similar to the US, previously released GDP estimates are revised to reflect newly available information. That concludes the material we will cover in this lecture. Now let's have some fun and test your understanding of the concepts we covered in this lecture with some active learning questions. Which of the following statement is not true regarding the definition of GDP? It includes production within a country. It uses the market value. It is measured over a period of time. It includes intermediate goods. You may want to hit pause, think about your answer, and I'll be back in a second. Okay, so in the response A, it says it includes production within a country. Well, we know that that is true. That's the definition of gross domestic product. It measures the production within a country's border. So that isn't the correct answer. B says it uses the market value. That is true because we know that gross domestic product is a measure of the final value of all goods and services sold within a country's borders. C, we know, is also true. We know that GDP is measured over a given period of time, usually over a quarter of a year. D says it includes intermediate goods. Well, we definitely know that that's not true. We know that that's not true because if it included intermediate goods, we would be double counting. So the correct answer here is D. Next question. Here you are asked to watch a short video clip of President Trump speaking about gross domestic product. Then you need to select which of the following statements on the right correctly state what error Trump has made in his statement.
Last quarter, it was just announced, our gross domestic product, a sign of strength, right? But not for us. It was below zero. Who ever heard of this? It's never below zero.
Okay, so did Trump mean to say GDP can only be zero in a recession? Or did he mistakenly refer to the level of GDP but means the growth rate? Is he confusing the income and expenditure approach? Or is his figure of zero resulting from the subtraction or from subtracting the value of the underground economy? So hit pause. Okay, did you guess what the correct answer was? The correct answer is B. He is mistakenly referring to the level of GDP, but means the growth rate. So given our lecture today, I hope that you could clearly see that we cannot have a GDP of zero or below zero, because if GDP was zero, that would mean that not one good or service was produced within the borders of the United States. Clearly, President Trump meant to say that the growth rate in GDP was less than zero. And this does happen, and it typically happens in recessions. Here you are asked to watch a short video clip regarding the significant decline in GDP as a result of the COVID-19 outbreak. Then you need to select which of the following statements on the right is correct regarding the statements made in this video.
First of all, Carl, the figures are annualized, which is fine when you have a growing economy, which happens about 95% of the time. So if you look at it, it's really more like a 9% drop, 9.5% drop, because we annualize it, assuming it's going to continue for the full year. That's clearly not going to happen because this really is a pandemic contraction, and we've seen it in the data with March and April being extraordinarily weak, and then seeing record growth in many series in May and June, retail sales, industrial production, employment.
Okay, so which of the following statements is correct? So hit pause. Okay, I'm back. Let's look at statement A. So it says that economic activity fell by 32.9% just within quarter two. Is that correct? Well, no, we know that that's not correct because we know that the reporter here mentioned that the 39.9%, that negative drop, was annualized. So it can't be just referring to what happened in quarter two. In B, it says economic activity increased by 32.9% in the entire year. Clearly, that is not true. Clearly, we've had a drop in economic activity because of the COVID-19 outbreak. C says since the 32.9% figure is annualized, it is higher than the actual amount that occurred in quarter two. That is actually the correct answer. So, as we learned before, the reported figures usually are well, in Canada and the US, they're reported as annualized. So it's just put into a yearly context. You can simply just divide it by 4 to get a rough estimate of what the actual drop was in the quarter that it's referring to. And so in this case, it was roughly 9%. So the correct answer here is C. This next question asks, which of the following statement is true regarding the release of GDP data in the US and Canada? Hit pause. Okay. So in A, it says, it is only released on a quarterly basis and previously reported estimates are rarely revised. Now, is this true? No, we know that that's not true. There's usually a series of releases, and as new information becomes available, previous GDP releases will be revised based on this new information. B mentions that estimates based on the expenditure method are released monthly, and those based on the income approach are released quarterly. Well, that is not true. Both of these approaches are used to come up with the GDP figure. As we saw when we learned how to actually calculate this, both approaches will result in the same estimate. And if you were to look at the details of each of the releases when the data is released from the statistical agencies, you can look in and see how each of these methods were calculated. C says variants of data are released monthly and quarterly. New data is commonly used to revise previous estimates. Well, that's actually the correct answer. And now if we look at D, D says estimates are always based on both intermediate and final goods. We know that this is not true. The estimates are of the final dollar value of all goods and services produced. So here the correct answer is C. Next question. Suppose that nominal GDP is greater than real GDP within a particular year. Which of the following statements is correct? Hit pause. Okay. A says prices have fallen since the year we use as a standard for constant prices. Well, that's not true. If nominal GDP is greater than real GDP in a particular year, then we know that prices must have increased. Because remember, when we calculate real GDP, we remove the effect of prices. And so if nominal is greater than real GDP, prices must have risen. In B, it says there must be a calculation error because nominal GDP is always less than real GDP. Well, we know that's not true. That is only true if the prices were to fall in a particular year. Then when we make the adjustment for prices, the actual real GDP would be greater than the nominal. Typically, though, prices tend to increase every year. There are exceptions, of course, in recessions where you do see some minor deflation, but for the most part, prices increase over time. And we will cover that in more detail in the next lecture series, which is going to be on consumer prices and inflation. In C, it says the population must have increased, otherwise nominal GDP would be less than real GDP. Now, that is not true. If over time an increasing population would likely result in more economic activity. So over time, you would expect that to increase real GDP. But in this question, we're just looking at a particular year. We don't have many different years. And also, when we incorporate population, what measure are we usually speaking of there? Well, we would be thinking of GDP per capita. And clearly, this question has no information about that. So C cannot be true. And if we look at D, it says prices must have risen compared to the base year. And exactly that is the correct answer. In this question, you're given a table on the right that contains GDP data over a 1-year period. All the figures are in billions of dollars. And it's asking you to calculate the value of GDP using the expenditure approach. So give this a try, hit pause. You may want to use an Excel spreadsheet to do the calculations quicker, or if you have a calculator handy, that's fine as well. So hit pause. Okay, I'm back. How did you do? So how do we calculate GDP using the expenditure approach? Well, we add consumption plus investment plus government spending plus exports minus imports. And in this question, we're told that consumption is 2,884. So that's this row of the table here. We're told gross investment is 535. Remember, when we calculate the GDP using the expenditure approach, we're adding in gross investment. We do not subtract off depreciation here. The next item is government spending or government purchasing, and that is told to be 524. And then we're also told that exports are 32 and we're told that imports are 35. So here we're going to have a -3 in terms of net exports. So we ended up buying more from the rest of the world than we sold to the rest of the world. So if we crunch the numbers, we get that the answer is 3,940. Well, we've come to the end of the lecture. I hope you enjoyed it, and thanks for watching. My next lecture in this series on economic indicators will be on price indices and inflation. So stay safe, take care, and bye for now.